Morning all, and thank you for joining us for our fourth edition of In the Room. Today we are joined by Tom Walker from Schroders, all the way from London. Welcome, Tom.
Morning, Steve. How you doing?
Yeah, no, good. I'm sure it's a little warmer actually in the UK than it is here. We've just been hit by a massive cold front, and it's I think it hit Cape Town yesterday sometime, and it's now hitting Joburg. So I'm sure I think the sun's shining a lot brighter your side than it is this side. So Tom's joining us. Tom is from Schroders, as I mentioned, and Tom's going to speak about the Global Cities Fund, which I think is a very interesting topic, especially with this current environment and kind of what we see going around us. And I'm interested to get an international or global view on kind of the real estate market. But before we get into chatting with Tom, just a couple of normal house rules. So first of all, these webinars are an hour long, so they run from 10 to 11. So we'll finish 11 o'clock sharp, or if not before, we definitely won't go over. The aim, as always, is that they're interactive webinars. So it's Tom and I having a conversation, chatting. But please, for the audience, please ask questions and post your questions on the Q&A. So on your Zoom, and I'm sure we're all familiar with Zoom by now, but if you're not, at kind of the bottom of the Zoom, there's a Q&A tab that you can click on and post your questions. Don't use the chat. The chat is actually disabled at the moment, so please only use the Q&A, and I'll try and get to every question if possible. Always important is the CPD process. So we always get asked about the CPD process, and some of the feedback we get post these webinars is that I don't explain the CPD process well enough. So basically, I'll explain it now, and I'll explain it again at the end. The CPD process is quite straightforward. You will get a thank you email after the webinar with the recording of the webinar. I think we're also going to put a link to a nice kind of article that Tom wrote quite recently. And then lastly, is the CPD assessment. And then you complete the assessment, and then you're awarded your CPD points for the webinar. So it's quite straightforward. Unfortunately, you have to attend the webinar to get the CPD points. You can't listen to the recording. That's part of the process. Cool. I think that's it in terms of house rules. We'll jump into kind of the conversation. So I think first of all, Tom, Tom, as I mentioned, is from Schroders. And I think most people probably have heard of Schroders, but not everyone might be aware of exactly who Schroders are. So Tom, if you don't mind, could you give us a kind of a brief kind of a highlights package of who Schroders are, just to kick off with?
Yeah, absolutely. Thanks, Steve. And yes, it is nice and sunny here in London, and we're incredibly grateful for that, because if we had the normal English weather, the lockdown would be so much harder for us. But yeah, so who is Schroders? So Schroders is a global asset manager. We've got about $560 billion under management in all sorts of. So you're kind of textbook large global asset manager, but I think the key thing that differentiates Schroders is probably the 200-year history that we've got. So the largest shareholder is the Schroder family, and that gives all of the fund managers in the group a huge amount of confidence in terms of the long-term nature of both the company and the time that we all get to, reinforce sort of the good investment decisions that we can be making over a long term. And that's sort of, I think, the key thing for people to understand about Schroders is that long-term history and the stability that the family gives everybody at the company.
I was on mute. So it must be one of the oldest asset management, fund management business in the world then.
Yeah, I think so. I'm not kind of an expert on fund management history, but I think we'd certainly be in the top couple.
Yeah. Gee, amazing. Yeah. But then, I mean, it's also so you run the global cities fund with Hugo, and then I mean, it's so tell us, I mean, just I mean, broadly speaking, what other kind of capabilities are the Schroders kind of have in their stable?
Yeah, so in terms of the group itself, as I mentioned, they've got funds across all the asset classes. But what myself and Hugo focus on is the Global Cities Fund. So we're real estate specialists. We've been operating and investing in this area for over 20 years. We've been working together since 2006. So we've got a very long-term track record together. We actually only joined Schroders about 5.5 years ago, but we were working together, and we, if you like, kind of our own sort of particular flavor and view and perspective on real estate to Schroders, and sort of really sort of changed the strategy of the fund when we arrived at the firm to really focus on the largest cities around the world.
Okay. And then, I mean, and tell us, I mean, so you talk about, so again, the fund's called the Global Cities Fund. I mean, what is your definition of a global city?
Yeah, I think, for us, when we thought about this fund, the key thing that we realized when we had been investing in real estate markets around the world was that the one consistent factor that drove income streams to get higher, asset values to get higher, was urbanization. And so for us, it was completely natural to have a cities-focused fund. And yeah, your question is pretty key. So what does characteristics that we analyze with a huge amount of data, and then that really helps us determine whether it is an established global city. So we look at the economic strength of a city. Scale is so important because cities are actually quite interesting, if you like, organisms, if you can call them that, where actually they get more efficient the larger they get. You and I are going to get less efficient the larger we get, but cities actually get stronger and stronger with the clusters and the efficiencies that they bring. We also look for their proximity and their ability to innovate, the talent pool, world-class universities. Then we look at transport connectivity, and then we look at the characteristics we look for to determine whether a city is really a truly established global city.
I mean, give us an example then of like, so maybe give us 2 examples. Why don't you give us an example of a city that is obviously a global city, but maybe one that we think is a global city, but actually isn't this year a global city, or doesn't have a great investment opportunity as a global city for whatever reason.
Yeah, I think maybe sort of a good example of a city for us, which is probably, a global city, but we don't particularly like from an investment point of view, might be somewhere like in the Middle East, maybe like Dubai, where you have no real kind of planning restrictions of any nature. So there's a lot of urban sprawl. There's no tension in the market. There's no rivers or mountains or strict planning regimes that limit supply of real estate. So more assets get built and built. They're also probably too reliant on one industry, being oil, and that really scares us. Detroit is always kind of the classic example of a city too reliant on one industry that you can sort of have seen fail. So I think that's probably, a good example of cities that might have a global, to us. And then in terms of, I think, global cities that you might not expect, I think at the moment for us, some of the most interesting cities that maybe people haven't heard of would be in China. Places like Shenzhen, Guangzhou, Hangzhou are really, really interesting cities, and they may not be on the top of everyone's list when they think of Tokyo, New York, London, Paris, that type of thing.
So interesting. So again, I think your point is that a global city is not necessarily an international city. Like or maybe it is, but I suppose in terms of an investment opportunity, it's far broader than that. I mean, would you just bring it closer to home slightly? I mean, would a Joburg or a Cape Town be a global city, or is it we're not big enough? We don't have the scale.
Yeah, it's a very popular question, that wherever I am in the world, wherever I'm speaking, they're like, how does our cities rank? Because we have rankings, and when I've been in South Africa before, it's a question that I get every time. And Johannesburg ranks higher than Cape Town. But when we look at all of the data, and the data telling me where the cities rank, this is not my personal opinion, because otherwise, obviously, the two African cities would be number 1 and 2. But actually, Johannesburg still, whilst it's higher than Cape Town, ranks around sort of 210, 211 in our system. So it's not particularly high when you think that we as investors are around the world. That's sort of, the kind of gives you the magnitude of, sort of the difference between how, the data tells us what's going on in Joburg versus what's going on in a Tokyo or a Sydney, for instance.
Yeah. So I actually I'm going to come back to data a bit later, because again, I know it's a key part of your investment process. But I also don't want to lose the point about this urbanization trend, and then what's happened in the last, we're 2-3 months with the COVID-19 crisis. So first of all, when you've spoken about urbanization, again, my understanding of urbanization is very much, people and communities flocking to cities, and cities essentially are getting more and more populated, and I suppose that brings your scale, innovation, all those things with it. But now, obviously, what's happened is that with COVID-19, we're not incentivized to all be together. So is that not going to have a negative impact on this urbanization trend?
Yeah, it is. I mean, it's sort of, it's a key consideration at the moment. And you're right, all the big cities around the world are the epicenters of kind of COVID-19 and the disease being passed on because of the density of population. And so we've thought long and hard about this. And I think that really where we're getting to is that if no vaccine for COVID-19, what we believe will happen is that you will have less interactions that you have are still so important. We cannot just carry on communicating via Zoom. At some point, you need to go and meet people, exchange ideas, innovate. And so we think that when that happens, whilst it may happen to a lesser degree, it will still need to happen in a city, in a cluster of expertise. If you're in the medical industry, you'll probably want to go and meet people in Boston, which is the world's capital. If you're in finance, it might be London. If it's tech in Asia, it might be Shenzhen. That's where the expertise is. So we think that there will still be a need to go into cities. One of the interesting things that we've been reading about emerge out of this faster than other parts of the country. So, for instance, here in the UK, the R number for London is the lowest in the country. If you look at the southwest of the UK or the northeast, they've got far higher R numbers, higher than 1 at the moment. So, arguably, you could say that London will come through this the first. Another interesting thing is that actually, if there is no vaccine for COVID, does it then sort of lead to elderly people moving out of cities, and then the young people who are less affected and less concerned about this coming into the cities? So does the city get young? This need to meet and exchange information still continues, but yes, it may happen at a lesser degree, but we just do not see any reason for rural demand, if you like, in suburban office campuses or whatever it might be, to come stronger than what there may be in a city.
And also, but now what about the impact? For example, again, I'll use so kind of innate to our work for. There's now talk of, we don't need the office, the big office that we've had up until this point. Again, I'll use one of our kind of our larger company, Stanlib. We sit in Melrose Arch. It's a fancy office precinct. You got 500, 600 people sitting in the office, and the guy's going, hang on, if you can just halve that, it's a massive cost saving. And again, we're not the only ones thinking of this. Now that's going to have a different type of impact now on the real estate market again, which is a key part of your portfolio, surely.
Yeah, it is. I think you're right. I think that management teams around the world are going to be looking at a very easy way to cut costs. Working from home is being forced on everybody, and we can all now see how efficient it can be. It still, as I've just mentioned, doesn't sort of replace that actual meeting of a person. I think we all miss out from that, as we all kind of realize as weeks tick by in lockdown. But yes, certainly we think that businesses around the world will be looking to reduce their office exposure, no question. But we think that which goes back to my comment earlier about just saying, look, we don't think cities die because of COVID-19. So yes, I think
Yeah.
it will change office demand fundamentally. But actually, when I think about our portfolio, I'm not that concerned about it because we have a very, very low exposure to offices. We've got a very low exposure to retail. And we really see these two subsectors in the real estate markets as being fundamentally challenged going forward. So we think that pricing power of much, it's really important to understand that it's not just COVID-19 doing this. These trends were in the market before COVID-19. So actually, any half-experienced real estate investor should already have been positioned for these changes. Clearly, we didn't know the pace it would occur, but these are not new. Working from home is not new. E-commerce is not new. So, but yeah, to your point on offices, absolutely, I think it will lead to a lower level of demand for offices.
Yeah, and also, you talk about retail. I think it's, again, South Africans are, we like to shop. We are a consumer-led economy. And again, I think, we've got lots of shopping malls and those things. So you talk about retail. Retail is also going to potentially have a knock in terms of from a property or a mall perspective, but the e-commerce stuff is just going to actually take off. Again, as we've seen through a number of the trends, like your Amazons. Yeah, we got Takealot and that. I mean, what are the kind of the positive trends? You mentioned kind of that you've seen kind of an escalation in some of the trends, and what are the positives coming out of the situation that you foresee in terms of which your portfolio could benefit from?
Yeah, I mean, I think that to go straight from retail and the pain that is being felt across, shopping centres around the world at the moment, the obvious beneficiary is industrial. So if you think about a retailer who has a physical stop in a shopping centre, if he is going to sort of, stop using that physical stop and he's going to go completely online, the numbers are that he needs roughly 3 times the space of that shop in a warehouse so that he can have all his goods there ready to distribute to people. To demand for warehouses, distribution assets around the world, and this is a trend that we've been playing for a long time. Again, it's sort of COVID is not bringing this on, but we think it just accelerates this. I think one of the interesting things for us is that the elderly population were always regarded as going to be slow, and if they ever came to the party, if you like, of ordering, for instance, groceries online, we didn't really think that would happen, but now they're being forced. Trend actually will just kind of continue. So I think that's sort of an obvious beneficiary to COVID-19. The other one, and I've sort of been saying for probably 3 or 4 years now, in terms of my portfolio, probably the most interesting subsector we invest in at the moment is data centers. And so again, you think about all of the companies that we all work for. Probably before COVID-19, they might have had the capacity for maybe 10 to 20% of the workforce to work from home in terms of their capacity in data centers. Going forward, we think contingency planning for businesses is going to mean that each business will need the ability for 100% of their workforce to work from home if needed. Yeah. It's owing to a huge demand for servers in data centers. So it's really, that for us is a really interesting subsector, and we've seen share prices go up while COVID-19 has happened. So that I think I would highlight as being, a clear beneficiary of this, digitization of our economy and working from home.
You talk about the e-commerce thing. Going back to that point, I mean, my mum, who's nearly, she's nearly 70, and she was asking me how to buy shoes online on the weekend. I was like, I mean, surely you know how to do that. It's simple. But the elderly there, it's just also, I suppose, it's different to what they're used to. So I've got a couple of questions coming through. So here's the first one. There's been quite a lot of research coming out on the impacts of AI will have on the property and automotive industry. Some research suggests that there will be less desire for urban areas, especially with self-driven vehicles. Any research Schroders have done here? Can you give that a go? I mean, I suppose it's the impact that you kind of your automotive kind of your self-driven car stuff potentially has on urbanization.
Yeah, it is something that we've looked at a lot because, if you think that, I'm running a global cities fund, I am putting every bit of, dollars that I'm allocating into a city around the world. So it's absolutely crucial that I am ahead of all the trends that are in the market and ensuring that those trends are not going to disrupt my fund, my investment philosophy. And so we've obviously looked at self-driving cars, we've looked at self-driving trucks, what impact this all has. And again, we get to the same point as it's a bit like saying, just point that people will need to come into a central location to meet, to exchange ideas, to innovate, and then they'll go out again. Arguably, what self-driving cars does is it takes the pressure off public transport systems. But again, there are some cities where even with self-driving cars, you're not going to have everyone arriving in a city because the roads can't just take that transport. Again, potentially what it does is it may reduce the residential values of flats or houses in those cities, but it still will not take away that need to meet in a central location where those others go back out again. So it just will change travel patterns, we think, as opposed to removing the need for a city. That clustering of expertise is, we think, absolutely crucial. That networking opportunity, we think, is irreplaceable.
Funny you say that. It's so I also see in London there's been a massive spike in demand for bicycles. So which I think again is so interesting, is rather people don't want to get onto the kind of the packed public transport, but they'd rather ride a bike. And London actually,
yeah, that's right. There was a couple of sorry to interrupt, Steve. There's just a really interesting kind of anecdote and sort of looking at the UK society, because in addition to grocery shops, which are obviously deemed important to stay open during the lockdown, two other shops that were allowed to stay open was one, the off license, because clearly to have a drink is absolutely essential, and then number two was bike shops. So yeah, you can see the way that London's going.
Yeah, so unfortunately our liquor stores are only opening next week. So that it's been a very hot topic, sore topic, I think, in this country. So one thing we are getting some feedback that the sound isn't great. So maybe what we're going to do is let's try to turn our cameras off, if that's okay, Tom. And we'll rather,
okay, no worries.
just to hope to improve the sound. Okay. So hopefully everyone can still hear us. And that, sure. So yeah, got a similar feedback here. Okay. So let's carry on then, with kind of without the videos, if that's okay. So next question is how's your fund? How's this? I mean, it's actually a question on our list, so it's a good question from Anonymous. How's your fund performed throughout a complete market cycle? Are your returns back tested? So I think I'm going to add to that slightly. I think we also worry about, again, like, so for me, I always worry about how have you stacked up over the last kind of couple of months during the kind of the COVID or the kind of and the market volatility, and then your performance in the past, and then also then your future outlook to performance. So kind of I think a 3-part question there, Tom, if that's okay.
Yeah, no worries at all. So in terms of the, what's happened over the last few months, year to date, the fund is down about 12%. Clearly there's a huge amount of concern out there in the market. Real estate is always thought of as being a defensive asset class. We have outperformed sort of, global equity funds. So, whilst it's very disappointing that, we're down 12%, real estate is still proving to be somewhat defensive. Also, when you look against a broader kind of global real estate benchmark, we're outperforming that benchmark by almost 800 basis points. And I think that not only sort of focuses more on resilient cities, which always perform better in crises, but also one of the key philosophy points that we always look at is a company's balance sheet. So, we don't think anyone can call the real estate cycle. So it's about ensuring that you've got a company that is positioned for that crash when it happens, because nobody knows when it's going to happen. So yes, the last few months have been disappointing, but we think that, that's to be expected at such a dramatic time. In years, Hugh and I have been running the fund. we've generated returns around 5% per annum in US dollars, which I think is, probably from our point of view, slightly on the low side to what we would expect from this strategy. We're normally sort of thinking between about 6 to 8% over a 5-year period, and that's per annum, compound growth. So on the lower end of what we would be expecting. But I suppose if we've been having this conversation at 6 to 8% per annum, so it's maybe just a point in time. And then in terms of our outlook, we are continuing to be pretty excited about not only urbanization trend, but then also the types of subsectors that we're invested in. We only have about 3 or 4% in retail. We have about sort of 12, 13% in offices. So, call that sort of 15, 16% in those two subsectors. The rest of our portfolio, 85 odd percent, is in things like data centers, things like industry, very strong in terms of demand for them, and then resilience going forward. So our outlook, we think we are really well positioned for all of these trends that are in the market, and importantly, all of the trends that have been accelerated by COVID-19.
So Tom, I actually don't think the video being off is making much difference. So I think it's pretty easier and it's better if it's on. So I'm going back on. I think you can do the same. Because I prefer to see you. So I hope that, and again, I really do hope it's working for everyone out there. Okay, I hope that answers the performance question, which I think is next question is from Mark Schroder. So Mark and I actually went to university together. So how's it, Mark? So how much do you think barriers of entry will impact the major technological advances, such as the replacement of fossil fuels? Many are looking to invest in alternative fuels, alternative technologies. Could the major players who own bug patents cause delays, and if so, how long could such barriers persist? So I don't know if it's something you could answer or not. Doesn't
Yeah, it seems a pretty sort of technical question, not such completely related to real estate, but I suppose where barriers to entry are interesting for me would be in a place in the data center subsector where they are very, very technically, difficult assets to operate and build and maintain. And we certainly see a very, very high barrier to entry within data centers. Some of the leading companies are listed, real estate companies like Equinix Digital Realty, QTS, and then over in China, we've got some like 21 Vianet or GDS Holdings. These guys have got the first mover advantage coming to it. So I think the barriers to entry, it's an interesting question because I think it is very relevant for data centers. And one of the reasons why we don't necessarily like retail or offices that much is because they're quite easy assets to build. And, then you don't have a competitive advantage. And we're always focused on companies that have a specialization that mean it is difficult for others to enter their subsector.
Okay, so hopefully that answered Mark's question. Interesting question on oil and how oil impacts cities. So in terms of the outlook, so again for anonymous, and I must be honest, I prefer when people put their names because we know a lot of you, but I'm happy for anonymous. In terms of the outlook on the oil price, how does this factor into your assessment of cities? Are depressed prices good, or are you more concerned about the lower demand?
Yeah, so when it comes to oil, like other macroeconomic factors, whether it's central banks and interest rates, we are not a fund that makes any macro decisions. So, we're not going to start getting involved with, FX rates, prices of oil, what the central banks are going to do, and then start allocating our capital accordingly. We're really good at picking real estate markets and subsectors. We are not a macroeconomic specialist, and so we try and stay away from that. But clearly, oil and the price of it is going to have an impact on the global economy. And ultimately, real estate is a proxy of the moment we move into a global recession, is that our rental growth rates, our capital value assumptions are going to reduce. as the economy moves through a recession. So I think the best way for people to think about whether it's oil or whatever it might be that impacts real estate is we are just a proxy for GDP. If you're going to have lower economic growth, you're going to have lower returns from real estate and vice versa. So for us, over the last month or two, we've just been reassessing all of the assumptions going into our models, becoming far more conservative as we see, the overall environment becoming more difficult for landlords to increase their prices in particular areas. But obviously there are, differences and there are exceptions like in dusting to us.
So it's a couple of themes again, and there's some questions that relate to it. So one is just, and again, I hope I don't jump around too much here, so our first question is actually, again, talking to kind of energy sources, and again, I mean, how does the kind of the ESG impact and how do you take into account in terms of your portfolio, and also, I mean, is it taken account in the kind of global cities index?
Yeah, exactly. So ESG is a huge element of how we analyze both cities on the one hand and then the companies themselves. So for instance, one of the four factors when you asked me about what defines a global city, one of the factors that I spoke about was the environmental issues. We have built an incredibly sophisticated database that takes data, for instance, from NASA, the European Space Agency, the Japanese Space Agency, to understand the environmental risks of all physical point of view to the building. Will it get knocked over by a storm or an earthquake? We think about it from the human point of view. Will we be breathing in polluted air or drinking polluted water? And then we look at the policy side of things as well, like saying, what is the South African government doing about, water shortages? What is the Chinese government doing about polluted air, whatever it might be? So it's a very, very sophisticated database that then is able to rank cities around the world and say that the largest environmental risks are in this city and are the lowest city point of view. Then when we have selected a company, we will then look at the environmental, the social, and then the governance aspects of all of the companies. And ultimately, the better a company ranks on any of those metrics, the more we are willing to invest in it. And then vice versa. So you get to a point where the E, the S, and the G may be so poor for a company that slowly that they are resulting in our investment process saying the investment position in this company should be zero. So it just gets discounted because its ESG characteristics are so poor. And so it is a very, very important
and long term, let's be honest, for us, so in South Africa, ESG is still quite let's say it's a new concept because it's been around for a little while, but it's not, I don't think it's as prevalent as it is kind of in the global investing kind of market. Now, I mean, do you think a company with a strong ESG rating or culture in the long term will be a better company? Or is that part of it, or was it purely that actually you ought to be doing the right thing?
Yeah, I mean, it works from every angle. I mean, we just look at cities today and we just say a city cannot be economically sustainable without being environmentally sustainable. Businesses and people will not go to that city if they cannot be able to look after their employees or their families or whatever it might be. And it's exactly the same with the companies. I mean, if you think about a company, for instance, building offices in a city, if that new office building does not reduce the carbon footprint of the employer, then they're not going to be able to sign leases, because every organization today, when they're signing a new lease on a building, they want to move into a new asset that will reduce their carbon footprint. So you just simply won't sign a lease if you're not building a building that is environmentally sustainable. So for us, it is, absolutely crucial.
Yeah, and it's actually that trend. I mean, it's actually interesting, is that, we've seen that trend in SA, is that, again, buildings that are built 15, 20 years ago, nice buildings, they're not nearly as environmentally friendly as the new buildings built today. And companies are moving out, and they're moving into the new buildings because it's cheaper, and it's better for the environment. So that trend is definitely coming through here. So one thing is,
Steve, just to interrupt. Sorry, just on that. I mean, I think that when COVID-19 passes, I think we're going to see how quickly people can make an impact on the environment. Because if you think about the amount of travel that's been reduced, the pollution that's reduced, I think we're all going to say, well, actually, we managed to survive with, low emissions. This is going to be the focus. So we think this is what's going to be next. And so, we think that kind of our cities and sustainable cities are absolutely crucial. So, kind of maybe in a year's time, you and I'll be talking about sustainable cities as opposed to COVID-19.
Yeah, it's actually, yeah. Like you see the photos of what the swans back in Florence, or the penguins walking down the streets and things like that, which are great. And the cleaner water again. I think it's it was Florence. The water, the photos of the water is so much cleaner than it was a few months ago. So yeah, something you touched on just now was just residential property. So again, a question came from, it's actually, sorry Nelson, this was a while ago you asked this question. Do you invest in residential properties? I mean, you said you do have a little bit of residential property, and then kind of what do you see as a good investment in terms of the residential space?
Yes, so we do invest in the residential space. We think it's very interesting, but what we are investing in is the build to rent. We are not interested in investing in a developer that is playing market cycles. It's just too volatile, and we just don't like that. What we really like is owning blocks of apartments in cities like Los Angeles, New York, Boston, London, Tokyo, wherever it may be, where it's far too, so they have to rent. And they're moving to the cities because it's where the opportunities are. And so that rental income stream is very resilient and really, really strong, and grows because generally, the people in the apartment blocks that we own have got pretty good jobs. And what you're seeing, for instance, through this COVID-19 crisis, as you've got, shopping center owners collecting maybe 20% of rent, the guys that own flats, they're collecting 95, 96% of rent. So it's really resilient. And so we really like that just income stream that just compounds each year. So that's the type of residential we like to own. We do not like to play the market cycles, trying to think that we can call, residential pricing, a sensible game.
Yeah. So Mike also had a question on residential. I hope in terms of trends, I hope that answers your question, Mike. If it doesn't, just post it again and I'll answer it. Another question is from Stuart. You mentioned that Joburg was somewhere around 200 on your list of cities. You must have a top 10. Has COVID-19 exposed or created red flags with any of your top cities? And I suppose we can add to that. We can say, is it maybe the other way around as well? Is it maybe some of the top cities have actually improved their stance?
Yeah, so I mean, if you look at sort of schrodersglobalcities.com, you can see that we actually rank the top 30 cities around the world, and you can get more information on the factors that we're looking at. What we do with the cities is that we're actually ranking cities over a 10-year period. So something like COVID-19 is not going to change that top 10, in the next month or so. Arguably, what you will see if businesses or people start to move away from cities for one reason or another, every sort of 12 months when we update this, you'll see cities move up and down. The assessment that we launched at the beginning of this year, some of the Chinese cities that had been screening the risks, such as I mentioned, polluted air or water, was not didn't screen very well. So it's a very long-term focus. We're long-term investors, so we're not going to be moved around in terms of how the cities rank with something like a COVID-19 or a Brexit. That will come out as we update these numbers, in the future.
Yeah, okay. That makes. I suppose it's also like our picture is like an equity chart. The upper goes, and then you see these kind of little dips in the curve as a recession or whatever. But in the long term, it still actually keeps going up. Next question.
That's right. And I think sorry to just one other point was just that whilst the cities that we're looking at, we're ranking over a long-term investment horizon. As I mentioned earlier, clearly when we're analysing the companies on a spot basis, and something like COVID-19 happens, that's where the real kind of changes will occur when we're analysing the companies and the valuation, as opposed to the cities where we're just saying, look,
Yeah.
you know, all things being equal, this city looks interesting over the long term. If we can't find a company at the right price, then we're not going to invest. But it's just, it provides us with the hunting ground. That's what's interesting.
Yeah. No. So question from Doug. More than 50% of your fund invests in US property. Allocation to the rest of the world other than Japan is at 12%. It's fairly small. What is your thinking around, and the reason, I suppose, around this allocation?
Yeah, I mean, the US is one of the most exciting and interesting places to invest. You know, we are very happy having 55% of our fund in the US because of the value that they consistently add to us and our investors over market cycles. I mean, if you look back over the last 10, 20, 30 years, the US real estate companies far outpace all of their global rivals in terms of the value and the wealth that they've created from their strategies. You know, you've got some natural that we allocate capital to a part of the world that consistently outperforms other parts of the world. You know, I think over time that will change. As I mentioned, China is very interesting to us. I think that, you know, we've got around 6-7% of our fund in China today. I think in 5 years' time that will easily double, and it could be at the expense of either Europe or the US. I don't know yet, but it's just, you know, that's where the excitement is today. Cities like Boston, Washington, New York, LA, Seattle, San Diego, really interesting cities. San Francisco is being created. We should invest there. If China starts to, you know, see more of that wealth creation, well, then we'll allocate capital over there.
Yeah. Also, again, I mean, think about, again, you mentioned earlier, you spoke about universities. Again, a lot of those cities you just mentioned, the States, they've got very well-known, innovative universities. Innovation is massive in the States. So, and I know your favorite city is, I think, San Francisco. Am I right?
Yeah, that's right. Exactly.
Yeah.
I mean, just to go there is just, I find so inspiring. The tech businesses, the things you see over there, it's just incredible. And again, what I find fascinating is looking at the world's best universities, and then if you overlay that with the amount of venture capital that is raised around the world, and you see that there's almost a perfect correlation with the smartest universities in the world and where all the venture capital money goes. They're just trying to monetize these ideas, which is effectively what's going on in cities, you know, everywhere around the world today. So, you know, that's why it makes complete sense for us to see where the smartest people are, and that's where the smartest businesses are.
Yeah, it's fascinating. Another question from Tyrant. What do you think about countries realizing that China is actually communist? Okay, so maybe we won't go there. Yeah, sorry, Tyrant. I think we're gonna go there. We're not gonna get into political conversation here, I'm afraid. So question from Sanka. Again, it's not a direct question on the property, but maybe you got a view on it. How much is big pharma companies going to profit from the global vaccine, and who are the companies leading this? I don't know if you got a view on that or not.
Well, I haven't really sort of got a view on it, but I've got sort of an interesting anecdote in that one of the companies that we've had in our fund the entire time we've been running it at Schroders is called Alexandra Real Estate. They own assets that are called life science assets, which are basically laboratories. It looks like an office building, but inside it, it's just full of, you know, laboratories. And they have about 40% of their income, which comes from Boston. One of their top tenants, I think it's their 11th largest tenant, is a company called Moderna, who started testing a vaccine for COVID-19 in January of this year. And so that the life science industry in the US, where we have exposure to, is going to see even more structural demand for it post-COVID, as governments and private businesses realize that this is just such an important area to give money to facilitate research, and that will lead to an increase in demand for life science. Alexandria are the leader globally in this space, and so they will benefit, which means our fund will. So it is a really interesting area. We love this subsector because it's so specialist, and it's just not a normal office building which can be commoditized. It's very difficult to build, operate, and manage, And that's why we like these specialists like Alexander.
That's interesting. So again, one thing that we always get asked, and it's a good question, is that, you know, you find that, and again, South Africans are, you know, so the South African kind of property sector went through a period of great outperformance for a number of years. Had a recent kind of had a dip fairly kind of in the last recently-ish, in the last kind of two or so years, and we've always had, and I think South Africans have always had kind of high property holdings. Now, property is actually kind of can be more of a thematic play than anything else. And again, so now from an investor's point of view, how should they allocate to this type of portfolio? I mean, in your view on that?
Yeah, I mean, I think it's all about diversification. I think when I look at, you know, what this Global Cities Fund can do for investors, we can diversify you away from your domestic market. Most investors around the world, when I speak to them, particularly with residential, everybody seems to have far too much exposure to their domestic market, or maybe just personally with various residential properties around the country. That diversification is absolutely crucial, you know, and a great example as to why would be just to speak to, you know, some of the investors in the UK who had their entire real estate allocation in the UK before Brexit. Then Brexit happens, and then overnight they're looking at a very different risk return profile, and that they wish that they had diverted. You know, it's not kind of new news, but I think what we can provide is diversification across the strongest cities, and then across some of the very interesting subsectors which are very difficult to get exposure to. So I think that's kind of the first part of the answer. With regard to the South African REITs, which did perform very well, you know, I could invest in the South African REITs if I wanted to, but the things that we continue to come up against is, first is the governance and the corporate structure. We don't always believe that they are set up with me, the minority shareholders' interests at heart. If I don't believe that management team is working for me, I don't want to invest in them. And then secondly, we weren't particularly comfortable with some of the markets that they were going off to buy in South Africa that I might have wanted, like the waterfront in Cape Town. That was diluted by, you know, buying assets in other countries and Eastern Europe, or wherever it might be. And for me, those assets or those deals were being driven by the search for yield as opposed to a total return play into solid real estate markets. So it's just sort of a philosophical and strategic point of view led to, I suppose, us not investing in these REITs, and just a few points there for people to consider when they think about their exposure going forward.
And then a time horizon, if one's investing in your portfolio as a piece of it's kind of as the piece of my asset allocation.
Yeah, we always sort of speak to investors over a 3 to 5 year, you know, time period. That's certainly how we would like to be judged. I think in a 1-2 year time period, various things that can happen can throw your strategy off, but over a 3 to 5 year period is really conditions, and you can really sort of see your investment philosophy and strategy pay off. And that's certainly kind of what's been the case for investors who've been with us over the last 5.5 years. So yeah, I'd say a minimum of 3 to 5 years. Again, this is a real estate investment, so you know, you don't really often buy a building for 1 or 2 years. It's always longer than that.
Yeah. So actually, these questions come through on your comments around some of the kind of Eastern European stocks. So yeah, on your point, SA property sector has heavy exposure to Central and Eastern Europe. What are your thoughts on cities and RE companies, or RE companies within that region? I'm not sure, is that return on equity? I'm not sure what that RE stands for. You might know. How different does your portfolio look from the regional perspective? Do your strong city exposure give you more downside protections relative to others during downturns, including COVID?
Yeah, so 2 questions in there. So there's what the Eastern Europe,
view on the Eastern Europe,
the resilient point of view. Yeah, so in terms of Eastern Europe, look, I don't really want to start commenting too much on the pros and cons of the strategies of some of the South African REITs, but what I will say is that when I look at the data that ranks the European cities and, you know, the top 10 European cities, there's nothing in Eastern Europe. It's London, Paris, Berlin, Stockholm. That's what's interesting to us. It's certainly nowhere in Eastern Europe. And going back to, the second part of the question, which is actually part of it, and really entire resilience of capital values of assets in the Londons and Parises, way outperform assets in other cities in those countries or across Eastern Europe. They are just more volatile economies, and so you should be understanding that. And so I think from our point of view, we will continue to expect outperformance from the Stockholms, Berlins of this world versus some of those European cities. And again, that is exactly why we just focus on the world's best cities. We're not looking to try and pick peripheral cities because we think we can time it, or we think that the yields there are attractive and soon they'll be institutionalized. It's just not a game or a probability set that we like to play.
It's actually one thing I also want to ask is that, so you look at, and again, it's kind of, I think it's this is a world trend, is you're seeing a lot of these kind of tech type properties pop up. I mean, so WeWork's a simple example, and we all know about WeWork. And I mean, again, in the South African context, we've now got I think 2 WeWork offices in Joburg and one in Cape Town, and they seem to have a great business model. But then they tried to list, was it last year, and they haven't got off the ground, and the valuations just keeps getting lower and lower. I mean, again, now what impact is someone like a WeWork going to have on the property sector in some of these big cities? Obviously, that's where they're targeting. And also, I mean, has a WeWork or guys like WeWork, I mean, have they got longevity in the market?
Yeah, I think that firstly, I think the flexible office space companies do have longevity in the market. Going back to this working from home thing, what we can easily see happening is that when we come into the cities or some of our businesses, they'll just say, right, well, just go and work in a WeWork for a couple of days or, a couple of hours. And so I think this flex, this, real estate on demand, everything today, Amazon, or office space, your hotels, your Airbnb, everything is just kind of, down to that last minute demand. And so this concept we think is absolutely here to stay. And one of the things that we wonder about WeWork is whether they are actually the Nokia of mobile phones. So they've come up with that genius idea. They're going to do very well. They've come up with a genius idea, but they haven't quite worked out how to monetize it. So another company is going to come out and actually sort of benefit from it, a bit like Apple have, or Samsung with mobile phones, and Nokia have been left behind, but it was their idea first. So yeah, I mean, I met a story, very sort of specific sales job, but the problem was they weren't making any money. And I think that what we're going to see as we move into this recession, that it's going to be very stressed for them and other flexible office space companies. But the whole concept is here to stay, because why will a business sign a lease for 5 or 10 years when they can just go to someone around the corner who's offering it for 1 or 2 hours? So yeah, we think that this will be here to stay. And again, it's another reason why we don't really like offices, because it's just going to be harder to maintain that pricing power if there are all these flex office space providers in the market.
Yeah, and again, my wife actually worked in one for a little while, and they're brilliant. They give you everything you need. Your costs are low, and you got a meeting rooms when you need it. And I suppose it's all about getting the right business model to actually make some money.
That's right. And I think that also, if you think about one of the comments I made earlier about, potentially COVID-19 can make cities younger. If you're young and you're starting your career, going to work in a WeWork building is just exactly where you want to be. Lots of like-minded people, getting to know people, really exciting. And so that's kind of, what we can see really, pulling people into a city. It's that networking, the exchanging information that I've mentioned. And so the concept is absolutely spot on, but there may just need to be a few iterations before it gets settled. And then, someone will come out and start making some money.
Yeah. So another question just come through. Do you have any exposure to Hong Kong? And what do you think of Hong Kong?
Yes, great question. So we've got about sort of 3% of our portfolio in Hong Kong at the moment. Interestingly, if we had this call about 3.5 years ago, we would have had about 7-8% of our exposure in Hong Kong. Now, we had no foresight as to the issues that are obviously going on there today and the social protests that we saw last year. But going back to the data that we use, about 2 or 3 years ago, we started to see that the Hong Kong as a city was not rising up our ranking. Instead, Chinese cities were. And so when we were thinking about to us that Chinese cities was where the wealth was being created, the economy was really growing. So we started reducing our exposure to Hong Kong and replacing that with exposure in Chinese cities. And so, that's been something that has protected us somewhat from what's going on there. I think that there will continue to be some issues, but we're very excited about the Chinese cities that we've actually got in our portfolio. And clearly there are huge question marks over Hong Kong at the moment.
Cool. We've got about 7 minutes left. So another question that came through earlier was actually about your data analytics. So again, it's something I think you've touched on in various pieces in the conversation, but we haven't spoken about directly. So I know that data analytics plays a key role in terms of how you manage your portfolio and your process. And can you give us kind of a bit more detail around that?
Yeah, absolutely. I mean, I think one of the things that's really key when you're an investor is to try and take the emotions out of anything. So, I obviously run a cities fund, and we've often joked with clients that it would be kind of the best thing around the world would just be to go around with a, unlimited budget around all the cities, work out where you had the best time and say, right, that's my number one city. But sadly, the investment world doesn't really work like that. So I need to quantify where the most interesting cities are. And we do that by data, which means that it removes any of that emotion. And we make sure we do that with companies as well. So when it comes to cities, we're looking at huge amounts of economic data to rank the cities. We're then looking at that innovation level, then looking at transport connectivity, scraping not only kind of the distance between, for instance, a transport hub and an asset, but also the volume going through that transport node to ensure we're in the most connected part of the city. And then I mentioned sort of the data we're downloading from people like NASA and the European Space Agency. So data is absolutely front and center in what we do and will always continue to be. We're working with, over 15 billion data points almost on a daily basis, being updated, making sure that we're allocating capital to the right parts of the world. And that will not change. It will just grow, and we will evolve it so it will get better. But it's certainly, I think, what differentiates our real people, we would regard as being a bit old school. They're still into offices, still into retail. We think about it from a data point of view first, and then let that dictate where we will then allocate our capital.
You talk about the emotion. The one thing I've always found with the property investing is that you can see it, you can feel it. So you drive past the nice new fancy building. You can so everyone's got an opinion on it. So which I think always fascinating. So I think those data. So I suppose then emotions are pretty slightly heightened kind of when it comes to the property side. So data is so important. Okay, so I'm going to take one last question that's come through, and then we're going to wrap up. So the question is, so what keeps you up at night? Given that you manage the fund, you've managed to pretty much avoid bricks and mortar retails. That helps and even better. The question is now, what would would be great to hear what you see the big risks going forward are.
Yeah, I think that in terms of the big risks for us, a global recession is not helpful. It will reduce the total return that we are going to be able to generate. But as I said, we're still very confident in terms of those subsectors that we're in that will see growth, the data centers, the industrial of this world. I think that as a real estate investor, deflation is something that is, not a good situation to be in. But again, we focus on companies with low levels of debt, so we will, be able to deal with it. But that would not be a good environment globally for real estate. Outside of that, I think it would just be any of the normal things that any investor would cite, trade wars, crises, particular things in one country or another. So there's nothing unusual that sort of scares me. But yeah, in terms of what keeps me up at night, every week it's something different. There's a debate we're having over a stock or analysis that's just come in. It's just one of the things about investing globally is that there's just never a dull moment, and I love it for that, and then I hate it at the same time because you don't really get any peace and quiet. But it's certainly an inspiring market to work in because there's always something going on, from Hong Kong to China to the US to Brexit or Europe, whatever it might be. It's never a dull moment.
And I suppose some of these shocks can come in from anywhere, which mean they can come in at any time of day or night. And you need to be aware of them. So actually, I think I'm going to ask one more question because it's come through. Actually, again, talks to kind of some of the earlier point in Hong Kong. Is Ray Dalio recently published a note on the rise of China and the fall of the US. Does your data support this trend, and have US cities been slipping on your list? So I suppose you kind of did speak about it because you said that you see China as the kind of the new big opportunity, but maybe elaborate slightly more on that, and then we'll wrap up.
Yeah, I mean, in terms of the top 30 cities, and you can see it in our website, it's really, you can generalize it and say, look, it's a battle between Chinese cities and US cities. There is still a higher percentage of US cities in the top 30, but my gut feel is that each year we update this data, you're going to see more Chinese cities in there. When it gets to 50-50, is that in 2 years' time, 3 years' time, 4? I don't know, but the direction of travel is clear. And that's why 5 years ago, I had maybe 0.5% in China. Today, I've got 6 or 7. So you can just sort of see the direction of travel. Whether China, usurp the US and start kind of doing better than them, I don't know. Again, I don't really want to make a prediction. I'll let data tell me. But certainly the direction of travel is for us to allocate more to China. Whether it comes from the US or whether it comes from Europe, I don't know. My suspicion is, and again, if you think about demographics, it could actually be more likely to be from Europe than it might be from the US.
Yeah, cool. Okay, thanks, Tom. I think that's pretty much it. So just send some closing remarks from my side. Just a reminder of the CPD process. So as I said, we'll send a thank you note to all the attendees. The video. The video will be on there from the recording, and then you'll have your CPD assessment on there, which you complete. What else is there? If you've got any questions, I mean, I think, please have a chat to the Innate business development managers. They'll happily help out. Otherwise, we've got some very nice stuff on our Innate website. And before I say thank you to Tom, one last thing, and I always get reminded because I forget to say this, is our next webinar will be on the 9th of June. And actually this is more of a kind of a practice management webinar, and it's actually we're talking about kind of the potential, the recent RDR paper that came out in our views in terms of how that can impact financial advisors. So it's between 11 and 12 on the 9th of June, but again, an invite will go out fairly shortly, and there will be some CPD points available for that as well. And then, yeah, otherwise I think that's it. Tom, thank you very much. Really do appreciate your time. And I think, guys, if you've got any questions for the Schroders team, I think there's Edith in SA. I'm sure you can give her a shout. And the website is actually also fantastic. So I think, if you just go Google Schroders Global Cities, there's a dedicated kind of page with a whole bunch of stuff on it on the global cities, which I really think is really, 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 really good. Yeah. So thank you, Tom. Really appreciate it. Good man.
Thanks, Steve.
Okay. Thanks all. Cheers.